I'm joined by Matt Strachan from Thorntons Investments. Matt, good to see you. Thank you very much for coming in. We're going to talk about AIM, obviously. What do you think the attractions of AIM in terms of sort of effective IHT planning are?
There's probably two really crucial ones. One is the speed. So as long as you hold business qualifying companies for 2 years and at point of death, then they should be exempt from inheritance tax. And the other one is you get to keep control. So unlike a trust or gifting where it goes out of your control, that's something that certainly is attractive to a lot of people.
And given investors have a lot of sort of choice nowadays in terms of where they invest, why would you consider AIM again sort of be a potentially suitable route from an inheritance tax purpose?
There's a variety of reasons really why that could be the case, and the sort of topic du jour, I suppose, is liquidity. So it offers regular liquidity, especially if run well. That's an attraction itself. If you are not in the best of health, then you don't need any sort of medical qualifications, so it gets rid of that. And increasingly it's becoming cost effective as well, particularly with the implementation on platform.
So leading on from that, what sort of type of investors should consider AIM as an investment route? Is it somebody with a higher risk tolerance, or is it somebody with a sort of broader set of objectives given some of the things that you've outlined sort of previously?
That's a good question. I think traditionally the obvious route was perhaps somebody with a potential inheritance tax issue, very much in later life. Would be a case where time was considered to be of the essence. Then that would be a very obvious market. Increasingly in recent years, we've found that ISAs have become a very popular route into AIM shares. The rules were changed in 2013 so that AIM shares were eligible for use in ISAs. And we know that there are a considerable number of very large ISAs about. The surprising thing, though, is that many people with an ISA don't realise that they fall into your estate at time of death. So that's one area where we're seeing quite a lot of people become involved.
And what do you think sort of has been driving this phenomenon in the last sort of 4 or 5 years, where AIM has become incredibly popular for IHT purposes?
It's the ISAs that we mentioned, I think, is one particular route. I think also it's a reflection of the ever-maturing status of AIM as a market. It's an area I've covered very closely for a long period of time. And there are a huge number of things about it which are attractive. Unfortunately, it's the negative aspects that regularly get all the press attention.
I guess the sort of popularity in terms of success of share price performance of companies like ASOS and Fevertree has probably sort of helped as well, hasn't it? It's sort of drawn people to it.
Absolutely, yes. And those are the sort of positive things. But we think the AIM market is currently around about 900 companies. It is probably, arguably, I would say it is probably more crucial than ever, given the sort of Brexit stramash which has been currently going on.
Yes.
This is a very vital part of future UK PLC. So I think some people are beginning to understand that there's a vibrancy and dynamism that has an attraction in and of itself.
And given for some advisors, AIM will be a new market for them to consider for their sort of client base. What sort of areas, when they're doing their due diligence, should they be looking at with the AIM investment manager that they're considering picking?
There's a number of things which I think advisors should be looking at carefully. I think they should think obviously about costs, which have been getting better but traditionally have been fairly expensive. They should probably also look at the history of what's been offered. Does the provider actually have a long history of involvement specifically? There are some unique aspects about AIM on that front. They will obviously be interested in performance. Performance is an area where actually a little bit of careful reading of the small print will go a long way. There are quite a few providers out there, when you actually look closely, their performance is based on a manager's portfolio or an original portfolio, and may perhaps not quite correspond to perhaps the sort of performance that their end clients receive at the end of the day. And then I think particularly where they're investing on platforms, knowing that the provider actually has a good working knowledge of platform functionality is really important, and that's something where we have experience that it's not like running a fund.
Yeah.
Now, I have a background history of being a fund manager. I know what that's like, and I know that running on a platform is very different. So trying to ensure that sort of constant liquidity and efficiency, making sure that trades don't get stuck, and making sure that you don't unwittingly generate trades. So where this very much differentiates from a fund is the sort of end of life use. So we are trying to make it as painless as possible for both an advisor and the client, and so it's a clean submission. You don't get these little micro trades from not understanding how a platform operates.
So actually, you've begun to answer my next question kind of already, but which is going to be sort of, what do you do as an AIM manager? What are your responsibilities? I mean, clearly picking individual stocks is kind of part of that, but lots of other fund managers. But you've alluded to it. I mean, the some of the nuances of trading on AIM are quite different from perhaps, you know, the kind of large cap market that advisors might be familiar with.
Yes, no. Obviously, the picking stocks is a very crucial component to putting it together, and we are very careful. You know, as we mentioned previously, there are a lot of headline, unwelcome news stories that come from AIM. So we will always do our utmost to try and avoid those. But you also need to think very carefully about the construction of the portfolio, ensure that you've got a proper diversity, that you are managing the risk carefully, and that's something, you know, we have a lot of time spent on how we manage the risk, both at company level and construction of portfolio level. And we're very proud of the sort of record we have in minimising the downside on that side of things. But it's the portfolio. The key thing is, I suppose, that most platforms, you don't control the dealing. It's the platform that controls it. If you make changes, it can trigger a lot of follow-on actions. So you have to do your homework. You really need to know what the algorithms are behind in terms of how a platform trades, and just to ensure that you can ensure that liquidity for lots of clients to come on board, and make sure that you garner all the cost benefits that a platform should bring. Yeah.
And you mentioned risk there, as you quite rightly say. It's kind of always uppermost in an advisor's mind. So within your portfolios, so what are the kind of level of stocks that you use, and what are the sort of some of the sort of headline kind of risk elements that you put into a portfolio?
We will always run with a minimum of at least 30 stocks. So 30 to 40 stocks would kind of be the normal size of the portfolio on there. We aim to be long-term investors in that. You know, we have a minimum 2-year investment horizon for obvious reasons. And therefore that long-term investment perspective means that if things are going well, there will not be a frequency of changing stocks within the portfolio. So the sort of the overall risk perspective of that is if these are meant to be long-term investments, one, obviously we're looking to be very careful in the selection, but also it means that we need to think very carefully about the construction of the portfolio. We do a lot of liquidity analysis to make sure that when clients' investments are made, it's as frictionless as possible. And so far, fingers crossed, everything has been dealt on a one-day perspective.
And what does liquidity look like in AIM from your perspective? Are you looking at the number of shares that are traded on a daily basis or on an average monthly basis to sort of figure out if that's the right kind of individual stock that you want clients to be in?
Yes, so generally we will not pick anything of less than a 50 million market cap, but that doesn't in and of itself ensure liquidity. So there may be a larger company, but if it's a very tightly held shareholder base, we can see that. And so it's looking through a number of different factors, but yeah, the average daily liquidity is quite important in the shares, and if we particularly like a smaller company, it will be a smaller position in the portfolio, and the portfolio is always run to the classic 5-10-40 rule of funds. You know, nothing above 10%. We run monthly tolerance checks to make sure nothing is out of position too far, and then anything 5% or above shouldn't aggregate to more than 40% of the fund.
Perfect. Let's talk about sort of valuation again. Always an important part of an investment decision. What's the sort of Thorntons investment sort of view as to value in the AIM market at the moment?
I actually genuinely think it offers some of the most attractive value we see at the moment. We are in a very funny investment environment at the moment.
Yeah.
You know, when you've got something close to $13 trillion of government bonds with a negative yield, this is not a natural or normal environment.
Yeah.
The nice thing, despite all the macro worries you might have and despite all the Brexit worries, is actually when you visit individual companies, it can be the most positive thing. In some ways, it is the most sort of natural, normalized investment you come across. You see a company individually, it has its own attractions, and the valuations are often really quite compelling, particularly in this current environment. So, strangely, with everything going on, it feels more like normal investment than many other areas of the market. So I'm greatly encouraged, despite all the concerns going on. And of course, the other interesting aspect of AIM companies is they are generally much smaller and much simpler than large complex companies. So whereas a pharmaceutical company has supply chains all over the world with product crossing multiple borders before it reaches an end product, small AIM companies are much simpler. They can change their supply very quickly. They can change their business model very quickly. And a lot of companies we see they're shrugging their shoulders, saying, well, we're just getting on with it. Come what may, hard Brexit, no Brexit, whatever.
Interesting. And sort of just kind of finally, what is it, do you think, that Thorntons Investments offers that is genuinely different from perhaps other players in the market offering similar solutions?
Well, a lot of it has to do with our background.
Yeah.
So we started as an investment service operation from a large legal practice back in '95, strangely the same year that AIM market was launched.
Yes. And only a year after EIS was launched as well.
Yes, that's right. Yeah, so a lot of things were happening at the same time, including the formation of Thorntons Investments.
Yeah.
So we have that legacy from the legal side, which does influence how we think about investment. But as a standalone company as we are now, we are close to about 400 million under management. We started actively investing in AIM shares for the purposes of inheritance tax relief in 2006. I joined as the Chief Investment Officer just over 5 years ago. I had a previous history of running small companies in particular across different markets around the world, so immediately fell into this as an area of interest. I realised that we were offering a particularly good service and was very keen that this be broadened out to a wider audience, hence our eventual sort of positioning on platform. So we started first on Standard Life platform just over 2 years ago, and feel that both the background of investing and our understanding of how platforms work has played extremely well over that past period of time.
Interesting. Matt, thank you very much for coming in.
You're welcome. Thanks for having me.